Hi everyone, if you are thinking about buying a house, I know it's very exciting and overwhelming at the same time, and there's a lot more to consider than just the purchase price. In this video, we will explore all the cost you need to factor in before making that big decision. This will be a step-by-step video in which I will be going over different costs associated with buying a house. I wish I had this guidance when I first bought my home. So hopefully this video will really help the first time home buyers, and even if it's your second time, it will still be helpful to you. Hi guys, my name is Parul. If you're new to my channel, I'm an economist by profession. I have worked in litigation consulting for many years. I have a graduate degree in economics from USC. And on this channel, I teach money management and how to achieve financial freedom fast. Before you jump into buying a house through a mortgage, let's first understand if your budget can handle those monthly mortgage payments comfortably. If you're not paying in cash, this is a big deal. You need to know what's in those monthly payments and if you can actually afford the home you're eyeing for. If you are not paying all cash, your housing payment is split into two parts. First is the down payment, which is how much money you pay upfront. It can vary from as little as 3% to as high as, all the payment. And the second component, which is the bigger one, is the monthly mortgage payments over the course of the loan. And I will explain both of these concepts in detail today. All right, let's start with the down payment. This is the money you pay upfront, typically a percentage of the purchase price. Most Americans pay less than 20% because they don't have enough money saved for the down payment of 20%. All right, let's get back to today's topic. The next big cost to consider is the mortgage. This is the loan you take out to cover the remaining home cost, which is the major chunk, usually um, 80% or more, because there are so many costs. And I will explain all of them in detail. So let's take a closer look at your monthly mortgage payment. What exactly are you paying for? Why are you paying it? And for how long? Once you understand this, it will help you make smart choices and find a home that fits your long-term plans. Okay, so this mortgage payment comprises of four parts, which are principal, interest, taxes, and insurance, or in short, PITI. So let's look at the first component, which is the principal. This is the actual money you borrow to buy the house. So in our example, it is $400,000. The second letter, which is the interest, is the fee you pay the lender for borrowing the money. I know nobody likes to pay interest, but unfortunately, to get thousands of hundreds of dollars worth of loan, you need to pay interest to the bank because they're loaning that money to you. Your credit score plays an important role in determining what interest rate you will eventually get. The lower the credit score, the higher the interest rate you pay. Okay, moving on to the next term, which is the taxes or property taxes. These are the local taxes you pay for property each year. And if you have bought your house even in cash and there's no mortgage on it, you still pay because this pays for your, roads, your firefighters, schools, parks, etc. Property taxes are due every year, but you can pay them monthly throughout the mortgage payment. Each month, you add a bit to your mortgage payment for property taxes. Your lender can hold this money in a special account called escrow. At the end of the year, the escrow company uses this money to pay your property taxes. It's like a hidden saving account that takes care of your taxes for you. Okay, so how now you might be asking, how are these property taxes calculated? Well, it depends. And there is something called an assessed value. A property assessor will determine the value. He'll examine the house and come up with what your house is worth. It is not equal to the market value. So the effective property tax rate for the US as a whole is around 1.1%. New Jersey has the highest rate around 1.8% and Hawaii has the lowest around 0.3%. Okay, now moving on to the last term, which is the I, and this stands for insurance. And this is similar to the property tax. You have to add this either to your mortgage payments, like monthly mortgage payment, through an escrow account. Where I live in California, the average cost of homeowners insurance is around $1,500 per year. I think it averages around 1,200 for the entire nation, and again, it can vary depending on your location and your coverage. Okay, let's understand this with numbers. So, how much will be your monthly mortgage payment? We will be using a mortgage calculator for that. Let's say you buy a $500,000 house with a 20% down payment. So, $100,000 would be the down payment, and $400,000 would be the mortgage. As of today, the interest rate for a 30-year fixed rate mortgage are around 7.475%, and this is from this website that I got. And now you can use this calculator to estimate your monthly payments based on loan amount, interest rate, and loan term. Again, you can go to this website here and input some numbers to see the results. And after I have inputted these numbers, I found that my monthly payment for mortgage, including the principal, taxes, and interest and insurance, are around $3,185. In today's video, I want to talk about why I think paying less than 20% is not a good idea. Because when you have less than 20% down, you have to pay something called PMI, or private mortgage insurance. This is the extra money that you have to pay when you are not paying the 20% down. So the PMI would protect the lender in case you default on your loan. This adds an extra cost to your monthly mortgage payment, and it will increase your overall housing expenses. The other disadvantage of buying a house too soon when you don't have 20% saved for down payment is lenders will offer less favorable interest rates to borrower who put less than 20%, and as they see them as higher risk. And it can significantly increase the total amount of interest paid throughout the course of the loan. It will also increase the loan term, because to offset the lower upfront payment, you have to extend the term of your loan. This means you will pay more interest over time. Okay, let me throw some numbers here to explain this. So, going back to our previous example, assuming you are purchasing a home worth 500,000 for a $500,000 house with a 20% down payment, which is $100,000, the mortgage amount would be $400,000, and the interest rate we will be assuming as of now is 7.475%. So using a mortgage calculator, we will calculate the total interest paid over the course of the loan. And in this case, it comes about $549,000. And in this case, there's no PMI since you already put 20% down. Now we will look at when you make less than 20% payment upfront, or in this case, let's assume it's 10% down. So the total mortgage or the loan that you are taking is $450,000, because you only paid $50,000 upfront. So the total interest paid over 30 years at 7.475% interest is approximately $686,000. Since the down payment is less than 20%, PMI is required. So this can vary from 0.5 to 1% annually. For simplicity, let's assume it's 0.8%. The annual PMI for this loan would be around $3,600. So over the course of the loan, which is 30 years, you will be paying a lot more, which can total up to approximately $108,000 in PMI payments. Therefore, the difference in total cost between 10% and 20% down payments, including PMI, is approximately $137,000 over the life of the loan. And you can see that it's a big number. This is an approximation. And of course, the interest rate and other terms will vary, but you at least get an idea. And for this reason, I think having a good grip on math is very important, because it opens your analytical mind, and when you have to make financial decisions in the future, you know you have the right tools to make it. My teenage daughter was once asking what is the use of math, and I hope once she gets into that phase when she has to make financial decisions for her, it will all make sense to her. Now let's look at the other cost of buying a house, which are the closing costs. These are fees associated with finalizing the purchase, typically 2 to 5% of the home price. They cover things like appraisals, inspection, and the lender fees. There are different ways to save on these costs, and I will explore that topic in my future video. And now let's look at another fees that sometimes some people might end up paying, and that's called an HOA, or the Homeowners Association fee. This is usually done in gated communities or townhouses to, pay for common areas like maybe a yard or like swimming pool or some, club facilities and stuff. But it usually is not there in the independent single family houses. All right, what could be some other costs? I think recurring cost of repair and maintenance is one such thing. It is hard to calculate, but a common rule of thumb is to set aside 1 to 4% of your purchase price of your house each year. For example, if you bought a home for $200,000, you should save around $2 to $8,000 per year for maintenance. If you have an older home, you have to set aside close to 8,000, because you may have issue with plumbing, flooring, roof, or air conditioning. Now, with all the information in the background, let's move on to the next section, which is how much house can you afford comfortably. There's no magic number, but a good rule of thumb is to keep your total monthly housing cost, including your mortgage payment, property taxes, and homeowner insurance, below 28% of your gross monthly income. Or more precisely, you can go with the 28-36 rule, which means that you should spend no more than 28% of your gross income on housing cost and no more than 36% of gross income on all debts, including your credit card, student loan, auto loan, and mortgage. So if you make, let's say, 60,000 a year, your gross monthly income would be 5,000 a month. 28% of that would be 1,400. So by the 28-36 rule, you should not be spending more than 1,400 on mortgage payment. Remember, this is a starting point. You will also need to consider other specific debts you have and your financial goals. As I said, cost can vary depending on location and the specific property, but hopefully this will give you a better understanding of what to expect when you're buying a house. If you have time, I will encourage you to watch this video next, where I talk about the pros and cons of buying a house versus renting, and if this is the right time for you to make that big decision. In my next video, I will also cover what are the different ways to save for the down payment of your house, including the short term, mid term, and long term saving and investment options. Please stay tuned for that video. And of course, if you like today's video, don't forget to hit the like button and subscribe to my channel. And thank you so much for giving such a great boost to my channel. I have seen a tremendous growth in the last 1 week, and I really appreciate your support. Take care and have a nice day.